were you taken by surprise by yesterday's interest rate cut by the Monetary Policy Committee of 50 basis points?
Yes, I think personally I was, because inflation has still been hovering very close to the top end of the band. So the decision, was on balance of probability, was likely that interest rates would remain flat. So it was somewhat of a surprise that they were cut. But I think what it does introduce is that there is a broadening in scope from the Reserve Bank in terms of what they can do in terms of that tool, because we always had Tito Mboweni lamenting the fact that it was rather a blunt tool, and asking his counterpart Trevor Manuel to also assist in help stimulating growth. So I think this approach, from being inflation targeting, looks like it would encompass a broader range, possibly looking at currency as well as growth, and that is the trend overseas. If you look at places like the US, they focus on both growth and inflation.
Is it going to have any meaningful impact on equity valuations in the consumer-sensitive stocks on the JSE All Share?
Yes, I think generally on the market it will have an impact, and initially on stocks, no, because it takes some time for these things to feed through to the market. And if one looks at the underlying market, those particular sectors that you mentioned, most of those counters, clothing retailers, some of the durable goods retailers, they're almost trading at all-time highs, or within a 5%.
The thing is, though, do you bet against that positive momentum at this stage? Do you think they've got further legs?
I think it's a sector that's held up surprisingly well over the last 2 years, and almost to a man, everyone has been surprised by the movement that's happened there. But I think what people fail to recognize is that there's been a major demographic change in South Africa, and we've seen more and more people coming into the mainstream economy, and what they might have lost in pricing terms, certainly we've seen an uplift in volume terms, and that's helped those retailing shares.
Greece and the fact that we finally have a bailout package on the table that appears to have been concluded. Do you think we're going to see positive momentum on the international front as the details of the deal unfold?
Absolutely. I think it's a very positive sign for markets. In the first instance, it removes the risk of default. The refinancing risk has obviously also appeared along with that. And then thirdly, it gives some credibility to the austerity plan that the Greek government has put forth. And I think it was very important to make a stance, because there are a lot of predators out there in terms of speculators, hedge fund managers, and if Greece had fallen or been allowed to default on its debt, they would have surely gone after the likes of Portugal, Spain, and then of course the UK, because they.
But now everyone's going to have to be bailed out. The bottom line, because it's not going to stop at Greece, or do you think that this is it?
It might. Those problems will remain, but I think it just it removes an element of risk, and shows that there is some support coming from the European Union, first of all, and secondly from the IMF.
Mixed data coming out of the US. We've had weak housing start numbers out. We've had positive consumer sentiment numbers out. What are you reading on the American front? Do you think that we are finally out of the woods, or is it going to continue to be a mixed picture for some time?
I think it is fairly mixed, and that's likely to be the trend going forward, and it probably will be as long as we have high unemployment. But I think the general trend is for improving numbers, and that's the most important thing. That the revised GDP came in at 5.6 versus an expected 5.9. That's pretty much irrelevant. What it does establish is that an improving trend is in place.
And earnings momentum, now that we're out of earnings season, what do you expect going forward, given the fact that the outlooks, I think the CEOs have been relatively cautious if you look at outlooks across the board, and perhaps that's because they have had their fingers burnt in this tough economic environment. Do you think that the CEOs are being overly cautious with their forward-looking statements?
Yeah, I think in good times they're overly optimistic, and in bad times they're overly pessimistic.
Not unlike the market, though, don't you think?
One only needs to look at Johan Rupert the Bear. Since his last statement, I don't know, probably 7 or 8 months ago, so, being exceptionally cautious on markets. That share is probably done in the order of 35% when he's been his most negative. But I think if I can paint a broad picture on the scenario as we see it, and what's been evidenced from the results that have come out is that cash flow has been exceptionally strong. As earnings contracted, turnover numbers have declined. Management have made a conscious decision to whittle down the costs. Because turnover has decreased, there's been less of a demand on working capital. Management have been unwilling to make any new investments. So as a result, we've seen free cash flow in most of the companies that we look at, and this is a trend that's evident overseas as well. That cash flow has actually been exceptionally robust, resulting in very strong growth. So what it means is the balance sheets of these companies are very strong, and if we look back at the business cycle over the last year to 18 months, the bull rally essentially started, call it 12, 13 months ago, with a liquidity-driven rally because there was so much liquidity in the system. That evolved into a profitability-driven rally as corporate profits started improving first of all, and then beat expectations. And I think the third leg of that rally will be an investment-led rally where we see companies starting to invest in more capacity.
We've spoken significantly about a number of people looking for value beyond the top 40 and drilling down into the mid and small cap arena. Are you embarking on that strategy, or are you staying firmly set on the top 40?
It certainly will look across any sector and market cap, depending on liquidity, and if there is value there, then I think then one can't ignore it. And
what about the dearth of research, though, into the smaller cap stocks? Does that have a bearing on your investment decision?
Typically, we do all our own research anyway, so we don't really follow what the sell side are doing. But I think, as you correctly say, the top end of town is focused on the top 40, and there is a lot of research on that part of the market. So the valuation gaps tend to be arbitraged out fairly quickly. But as soon as one looks at the mid to small caps, there does seem to be a delayed or lagged effect in terms of what's happening in the underlying economy. So we're seeing a lot poorer results now from companies in that part of the market than we are the top 40. And I think there are definitely valuation opportunities that are popping up there. And there are plenty of businesses there that will be around for 10 years.
Is there anything in particular that stands out for you at the moment?
Yeah, I think Altec is one that looks very good to us. Yesterday's interest rate decision will also bear well for the company because it is focused on the consumer with regards to its business that makes set-top boxes. It of course owns a stake owns AutoPage. I think the long-term growth for that business is going to come out of its East African data business. It owns a stake in Kenya Data Networks, and effectively that business a year ago was nowhere in the picture. And when they last reported results, it comprised about 20% of their earnings, and management actually forecast that business could make up almost 50% of the business going forward. So we see growth coming from that side of the business, and then just a return to normal profit levels from the rest.